More cases, more deaths, and more federal relief. As the coronavirus crisis wears on, millions of Americans are increasingly worried about their income, their savings, and their retirement. The question is, are you taking action to help protect your health and your money? It's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
Joining me right now is Sound Income Strategies founder and CEO David Scranton.
They've created a new type of inflation, and although markets have always been an emotional place, they seem to be even more of an emotional place these days.
Jeff Small, market watcher, is with me.
Stock market dynamic is getting ready to significantly change.
So let's bring in our co-host, Jeff Small, president of Arbor Financial Services, and also the brand ambassador for the Retirement Income Store. You know, it was just about a month ago that the White House urged individuals and businesses to follow strict social distance guidelines. More recently, those guidelines were extended through the end of April, and top health officials began recommending that people actually wear masks in public places. These are the steps that individuals can take to help protect themselves and their families from the coronavirus, as scientists continue to work to develop a vaccine to address the crisis at large. But as the government works to address the economic crisis at large, what steps should you take to protect your own economic stability, including your household finances, your savings, and your retirement income? We'll answer those questions and many others right here on today's show. We'll take a close look at actions taken by Congress, specifically designed to help retirees and near retirees, and we'll discuss the Fed's latest round of emergency measures. We're also going to be sharing an update on the markets and explain why it's so important for investors over the age of 50 to take action now to protect their money. Joining me again this week for the discussion is author, advisor, and my co-host, Jeff Small, along with our special guest, economist and market forecaster, Peter Schiff. Once again this week, we're giving you the opportunity to join the conversation. At any point, you can submit your own questions or comments via phone message, text, or email. Then we'll respond to your input live on the show. Before we bring out our guest, let's talk first about the Fed's latest actions and how they may or may not help. Recently, the Federal Reserve unveiled new plans to provide up to $2.3 trillion in loans to households and businesses to help get through the coronavirus crisis. The move came just weeks after the Fed had already cut short-term interest rates to zero and announced unlimited quantitative easing. While the first emergency package did little to calm Wall Street, the second round triggered a stock market spike. As you know, volatility has been extreme since the coronavirus crisis emerged, with the stock market being down by almost 40% at its bottom. As I pointed out on a very previous show, one positive sign is this crisis is that the Fed did act quickly, in fact, at lightning speed, compared to the financial crisis. Back then, it took 15 months from the first warning signs of the crisis for the Fed to cut interest rates to zero. This time, it only took 8 days. Of course, this is a very different kind of crisis, a crisis that in many ways is completely unprecedented. That's why the Fed's massive response effort is also largely unprecedented, and why the $2 trillion Coronavirus CARES Act signed by President Trump a few weeks ago was the largest such relief package in American history. Could these unprecedented moves by the government get the markets back on track before any further losses occur? Well, anything's possible. However, I believe it's more likely we'll see additional steep downturns in the weeks and the months ahead, possibly culminating in another major market correction on par with the last two, or possibly even worse. In the meantime, we may continue seeing short-term spikes as the market overreacts to ongoing relief efforts by the government. Ultimately, though, they're really just relief efforts meant to keep the plumbing moving in the financial system and the banking system and try to minimize the damage. That having been said, there are some specific provisions in the government's efforts meant to help retirees and near retirees deal with the crisis. We'll take a closer look at one of those coming up in just a moment. Now it's time to bring in my co-host, Jeff Small, president of Arbor Financial Services, a retirement income store in Melbourne, Florida. He's also the Amazon best-selling author of the book, Turning Financial Planning Right Side Up. Jeff, this past week, unemployment projections with 22 million new filings in the last 4 weeks alone estimating that the unemployment rate is now 17%. Clearly, I don't see any way it's not going to go north of 20%. What's this mean for the economy and the markets?
Well, I think we just saw 11 years of job creation get destroyed in a month, which is a record. We've never had this kind of unemployment. And this trend will continue as long as America is shutting down and small businesses can't afford to pay their people because they've got no revenue. And so what it means for the economy long term is, we're looking for a recovery maybe in the second half of 2021. Most of the Wall Street firms are modeling numbers with the virus that show they will decline and the economy will open back up, but it's really kind of based on a hope strategy, David. So right now they're hoping that's going to happen. And so, but as you know, there's going to be elements of social distancing that will become part of the norm. Wouldn't you agree?
Oh, I absolutely agree. And what's interesting, and I want our viewers to know this, Jeff, is that, it seems like all the Wall Street firms, all their models and all their projections and everybody else is based upon when we get back to the work. And when we get back to work is part of it, but still, not all industries are going to be able to bring all their employees back. And just because we get back to work doesn't mean people are going to feel comfortable spending right away. So to me, they shouldn't be wasting this time modeling so much when we flatten the curve, so to speak, and when we come back. Because flattening the curve means that if we get back too early, we may unflatten the curve and be through this again in another month. They really should be focusing on the long-term effects of the economy. And Jeff, for some reason, I don't see many analysts talking about that as much as they do this flattening the curve and what's going on with the virus. Are you hearing what I'm hearing?
I'm hearing the exact same thing. And these big Wall Street firms have this model that assumes we're going to get back to work in 6 weeks. And then we've hit the apex and hospitalizations are declining and mortality is declining. And so we anticipate getting back to the market highs in the second half of next year and having a normal economy. But I don't see how that's going to be possible without the eradication or vaccine in play. And so I think people have to be very careful here, even though we're up 28% off the lows.
Yeah. And no, I agree. It'd be interesting to see. We have economist Peter Schiff, whom you last interviewed actually just a couple months ago, coming on. It'd be interesting to see what Peter has to say about the economy, what he has to say about the stock market, because you're right. We still have those estimates out there looming from big banks that are saying 24, 38% drop in our economic output, what we call GDP, gross domestic product, in the second quarter of the year. And we're just starting the second quarter of the year. One firm came out recently and said it's going to be over 40%. Those are the numbers that I just don't see justifying a stock market like today that's really only down 15% from what we can argue is an overinflated record high to begin with, right?
Yeah, it really doesn't make much sense. A lot of people are scratching their heads as to why the market valuations have come back so quickly and why they are so high, why the economic reality of things says such a different picture. It's the worst economic data, David, that we may have ever had since the Great Depression. So there's a natural disconnect that's occurring, but at some point, reality will come back into the markets.
And Jeff, what I want our viewers to understand is that, the stock market is forward-looking. So right now, I think what analysts are looking at is they're saying, okay, this is something that's man-made. It's man-made because we decided to shut the economy down for the greater good because of the virus. And therefore, because it's man-made, it really was an economic problem to begin with. It should come back quickly. But again, what I think they're missing is that the economic recovery isn't going to be 6 or 12 months ahead. It could be 24 months ahead. And whereas the market is forward-looking, it's typically not forward-looking by 24 months, right? Am I missing something here?
I don't think you're missing anything. I think they're being incredibly optimistic because what we see as a social distancing standpoint is employers aren't going back to work, even if the governors and the president mandate it's okay to go back to work. Big employers are keeping their people at home. They're going to wait. And so we're going to see testing to get on an airline or a cruise ship or go to the Disney or a fever check. Everything is going to change until we can control this virus.
Well, and ultimately, too, we are creating a whole new generation today of germaphobes, right? Some of you sitting at home are probably thinking about that, right? You're probably thinking about, gosh, I've never used hand sanitizer before, and now I'm going to keep using it. Or, gosh, I've gone to the East on a travel, maybe my bucket list trip with myself and my spouse, and I see people over there in the East wearing face masks walking around. I always thought they're weird, and now, gee, maybe it's not such a bad idea. Maybe I might wear a face mask in large crowds occasionally. So we're training people to be different now, and as a result, they're not going to go back to the same old habits as quickly. And ultimately, because we just don't know the extent to which that's going to be a factor. And at the end of the day, if people don't go back in the same volume that they did in the past, the cruise lines are still going to suffer, the airlines are still going to suffer, restaurants could suffer, and it's going to affect the stock market for a lot longer. And for our viewers, it's important to know when Jeff and I are talking about stock market, we're not just talking about people investing in stocks, we're talking about you just investing in mutual funds in your 401k, for example. Ain't that right, Jeff?
It's exactly right. I think it's a very treacherous time for folks to be doing that. The market picture long term does not look good when we look at the current economic data. You can't lay off 22 million people in a month and then rehire them back in a month. It's a different trajectory. If it took 11 years to create those jobs, if we could do it in half that time, we'd be lucky. But the picture, David, is not just about the economy and the markets. Unemployment's going to get worse. It's going to double from here. It's not going away.
So you think unemployment can actually go to 35%?
I think it definitely can. There's no reason why it won't. Most businesses are going to be more restrictive than the government is, and they're not going to expose people or their customers to the potential for the virus, because we see mass contamination in different plants and different industries that have people working close together, and that's a warning sign. It's highly contagious. There's a reason why testing labs are outside of the hospital, because 10% of all healthcare workers are getting it. This is truly a bad contagion.
I've been thinking 25% is bad enough, 35% just terrible. Stay with us. I promise you, right after the commercial break, it's not all bad news. We have some good news to share with you too. So stay with us here right after the commercial break. We'll be right back in a moment on the income generation.
David J. Scranton's groundbreaking new book, The Retirement Income Story, will revolutionize the way baby boomers and their advisors plan and save for retirement. The Retirement Income Story, the story behind the launch of the Retirement Income Store, is about to shatter many of the myths Wall Street bankers have promoted and protected for decades. David outlines what he believes to be a much better method for planning and saving for retirement, one that doesn't involve taking on more stock market risk. In fact, most will be able to reduce and or possibly even eliminate stock market risk while creating renewable streams of income they can count on well into their retirement years. The simple truth is that if you were born in 1968 or sooner, you can't afford to ride out another catastrophic stock market drop like the ones in 2000 and 2007. Read The Retirement Income Story and revolutionize the way you plan and save for retirement.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
As mentioned last week, the coronavirus relief bill approved by Congress included a provision that suspended RMDs, required minimum distributions, for 2020. But what does that really mean? Well, remember that the CARES Act is a relief bill. And by suspending 2020 RMDs, the government is giving up short-term tax revenue to provide relief to retirees. The other rationale is that with all of the market volatility, suspending RMDs gives many Americans the ability to leave their investment portfolios alone and give them more ability to recover, hopefully over the next year. Unfortunately, there are some flaws with that rationale, which we'll get into in just a moment. But first, be aware that if you were slated to take your first required minimum distribution this year, you can now put it off until next year, thanks to the coronavirus relief bill. Now, as with everything IRS related, this is more complicated than it sounds. There have been many questions about what the 2020 suspension means for those who already took out their RMDs, as well as its impact on taxes and inherited accounts. In most cases, I believe those questions are best answered with the help of the right qualified financial advisor, ideally one who specializes in strategies geared toward retirement income. An income specialist can help you not only understand any possible changes to your distributions, but can also help you make sure your asset allocation is right for taking RMDs, which, as we always talk about, is more important than ever before given the current crisis. Now, this gets back to the point I made about the rationale for suspending RMDs for 2020 being partially flawed. For one thing, it assumes portfolios largely tied to the stock market will have recovered all or most of their losses by next year. While anything's possible, bear in mind that historically, it takes the stock market 6 to 7 years to recover to its previous peak after a major correction. Number two, it's based on the assumption that most people satisfy their RMDs by taking systematic withdrawals from a mutual fund. Now, while unfortunately many people do this, the current crisis illustrates why for most it's a very poor strategy and one that can put their retirement goals at great risk. The good news is that there are alternative strategies, and there's never been a better time to learn about them. Coming up, we'll talk about another timely defensive strategy that you just might want to think about. Now let's bring back in my co-host Jeff Small, along with our next guest, Peter Schiff. Peter's chief economist, global strategist at Euro-Pacific Capital, a division of Allianz Global Partners. Peter, thanks for joining us again today on the show.
Oh, well, my pleasure to be here.
We'll try not to turn up the heat too much because I understand you're sitting right now in Puerto Rico with no air conditioning, so we'll try to make this quick. Bottom line, unemployment this past week went up to a level guesstimated to be 17%. It seems like a foregone conclusion it's going to be over 20%. What do you think this means for the economy throughout the rest of 2020 as well as the stock market?
Well, both the stock market and the economy are in a lot of trouble, probably the economy even more so than the stock market, because what the Federal Reserve is doing may artificially prop up the stock market, but they're not going to have as much success with the real economy. In fact, the reason that the economy is so sick is not because of the coronavirus. I mean, that's probably making it worse, no question about that. But even before the coronavirus came on the scene, the economy was ill. And that's because of what the Fed did in the decade leading up to this disaster. So what we're really going to be suffering from is the hangover from all of the stimulus of the past, all the 0% interest rates and quantitative easing. And what the Fed is doing now in the aftermath of this crisis is only going to compound the problems that it created before the crisis.
So, Jeff, I know you've got some strong feelings and thoughts on the Fed and everything else, so go ahead.
Well, Peter, the last time you were on the show, you and I chatted about something. I'm going to shift gears for a minute. We talked about all this endless money printing, and this has got to be your worst nightmare because now the Fed has an open checkbook to cure all the ills here and be the buyer and lender of last resort. But, you know, you were really hyper-focused on inflation, and I don't see inflation ever occurring from money printing, especially with the deflation that we're experiencing. And one of your picks was gold miners on the show the last time, and gold miners have been obliterated. Even though gold is up 15 to 17%, most gold miners drop 200% plus in this correction that we have. So how can we have inflation going forward when there's no inflation? The Fed's been trying to create inflation for the last 10 years.
Well, first of all, most of the major gold stocks have hit new multi-year highs this week, so I'm really not sure what you're talking about. Yeah, there are some junior miners that have been weak, but overall, gold stocks are doing a lot better than the overall stock market year to date. Now, they should be doing even better given what's already happened to gold and what's likely to happen to gold. And I think that's going to happen. So I think people should be buying these gold stocks as quickly as they can. But as far as inflation is concerned, inflation by definition is money printing. That's what's being inflated is the money supply. So we've never seen the central bank create this much inflation in its history. To think that it's not going to affect consumer prices, I think, is completely ridiculous. I mean, it already is. Prices are rising for the things that people are really buying, like food.
Yeah, but Peter, money printing only causes inflation if it increases demand. Now we've got excessive money printing with no demand in this new corona economy. I think some of your viewpoints, Peter, are divorced from economic reality on some of this stuff because the way you frame them make them sound like that.
It's your opinions that are divorced from reality. Mine are grounded in reality. When you create money, you are creating inflation. Now, that inflation will manifest in various ways. I mean, when the stock market went up a lot, when the real estate market went up a lot, it was inflation that was driving those price increases, not the real increase in the value of the businesses, but the nominal price. And prices are going to rise. The Fed is putting money into the economy at a time where production is actually going down. What's happening as a result of the coronavirus is businesses are not operating. Goods are not being produced. Services are not being provided. Yet we are creating more demand by flooding the economy with freshly printed money. You're just focusing on certain prices. Yes, airline tickets are down. Nobody is flying. Okay, gas prices are down. Nobody is driving. This is only temporary. But look at what's happening to other prices. They're already rising, and they're going to rise even faster in the days, weeks, and months ahead.
So Peter, in the spirit of the terrible incident from the 90s and Rodney King's famous words, can't we all just get along? We have 1 minute left in the segment, so let me ask you the question this way. I understand what you're saying, but I also see that production is going to get ramped up. In fact, if the president has his way, it's going to get ramped up sooner than later. So in the last minute and a half we have, do you think it's possible that the inflation once again shows up in an asset bubble and it benefits the wealthy as opposed to the average person out there?
Well, inflation benefits debtors, when people who have borrowed money, particularly to buy productive assets, and it hurts wage earners, savers, people who have credit. Right. So that's going to happen. But remember, all of the stimulus, all of the bailouts have to be funded. They have to be paid by something. And if the government is not going to pay for it with taxes, they're doing it through inflation. The government is funding the stimulus and the bailout by stealing the purchasing power of savers and spending it into the economy. But again, there is no free lunch.
But Peter, just real quick, in the 30 seconds left, why do you think it can't happen as asset inflation as we've seen really since 2008? Because that just seems more likely to me.
That bubble is popped. We're not going to fund trillions and trillions of dollars of government spending simply by propping up the stock market. The public is going to have to pay the price of these bailouts, and it's going to come from the reduced value of their wages, the reduced value of their savings. The cost of living is going way up. The government is not taking people's money, but the government is taking the purchasing power from people's money, and they're going to feel that every time they try to buy something.
So, Peter, we need to leave it there for now. Unfortunately, to go to commercial break. So, bottom line, you still think there's going to be price inflation here in the United States, and who knows what the future holds. You could be right. Thanks for joining us again today, Peter. Thank you so much. You stay with us too. We'll be right back here with more coming up on the income generation. We'll be right back.
After a certain age, you shouldn't be overexposed to stock market risk. Yet, you might still be trying to squeeze every last drop out of today's market. And although fixed income investment can offer less risk than stocks, it doesn't mean you have to sacrifice return. In fact, recently some fixed income investments have actually outperformed stocks. But yet, you're still waiting to act. Visit theretirementincomeStore.com today to regain control of your retirement.
As I mentioned, the announcement on April 9th that the Fed was taking additional steps to combat the growing economic crisis actually gave Wall Street a rare boost of optimism. In fact, the markets were relatively calm that entire week, and the stock market trended cautiously upward, as the market was also calm the following week. This is actually a typical biorhythm for a bear market on the brink of a major correction. The market takes a drop, comes back halfway, then takes a bigger drop. It's called backfilling, and the cycle keeps repeating until the downward trend has matched or exceeded, most commonly, the last major correction. As I noted last week, historically, this next correction could potentially range from between 55% at a minimum to 80% at a maximum. Now, while this market may defy history and avoid that fate, I think the odds are increasingly slim given the magnitude of this crisis. We're already in a recession. The only questions now are how bad will it get and how long will it last? New unemployment claims have spiked by millions every week, and even after that number of new claims levels off, understand that the cumulative number of people unemployed will also be enormous. It's already estimated to be a 17% unemployment rate as of this past week. Also, many may not have jobs to go back to as companies without enough cash reserves to weather the crisis might go under. Recently, Morgan Stanley estimated that economic shrinkage for the second quarter could hit 38%. The bottom line is this: I don't see how this situation can possibly start getting better before it gets worse. I also believe that eventually the stock market will have to reflect in full this grim reality. Before that happens, though, we may see this backfill biorhythm continue for a while. And that's good news because it gives investors a chance to try to protect their downside from further losses by selling some of the peaks. You probably heard some of the market pundits who always tout the opposite. They always say it's a great time to buy the dips. Well, I say that now isn't a good time to buy dips. I believe it's more of a time to sell the peaks. So if you're a day trader or someone in your 30s who still has a job, okay, maybe buying the dips is okay. But for our income generation members, I say no. However, if you're in or nearing retirement, I believe your priority right now should be to try to protect your investments from further, potentially devastating losses. You may still have time to reduce your risk now with your portfolio down by maybe 15, 20%. Yeah, sure, that's a loss, but ask yourself this: how much will you regret not taking action if at this time next year you've lost 50% of your savings and are facing possibly 6 or more years to recover? Now it's time to bring back our co-host, Jeff Small, Amazon #1 best-selling author and also owner of Retirement Income Store right in Melbourne, Florida. Jeff, gosh, I've got to tell you, buddy, I thought you were a nice guy all this time, and I felt sorry for poor Peter there in Puerto Rico. No air conditioning, and you really turned up the heat. So listen, here's what I'm going to do. As soon as we finish the show, my friend, I've got this great book from this guy named Dale Carnegie that I'm going to send you at your home, okay, about how to make friends and influence people. I think it might be a good read for you, next week if you get some spare time, okay?
You know, Dave, that works in real life, the Dale Carnegie book, but it doesn't work on TV. And people have to answer for what their beliefs are here. And, you know, I had to bring some reality into Peter's life because I felt that some of his viewpoints were really kind of divorced from economic reality. He's half right, and I see him being as half wrong. So there is merit to what he says, but he's not exactly correct on some stuff.
Well, I thought that maybe he was right, but he was defining inflation in a different way. And that's why I piped in and pulled my famous Rodney King quote, because, you know, the reality is that we've seen asset inflation over the last bunch of years because this aging demographic and people aren't spending the way they used to. So all the money that has been printed by the Federal Reserve is really just going into assets, creating real estate bubbles, stock market bubbles, and so on. So it seems more likely to me that we're not going to have economic recovery because, you know, people are going to start producing goods and services. Companies are going to start right away as soon as they're able to. So supply of goods is going to be back. To me, the real issue is, do we go back to a stock market that's unrealistic? We're 2 years from now, when we're through the worst of this economically speaking, hopefully, cross our fingers, right? Then, you know, do we have a Dow at 40,000? You know, so we get a 50 to 80% drop, and then boom, you know, we get whipsawed right back to incredible new record highs. I mean, to me, that seems like a more likely scenario if you're going to argue inflation. Does that make sense to you?
I think it does. So I like to look at things, instead of theory, I like to look at empirical data. And so if you use Japan as the model, which we're about 7-8 years ahead of their monetary cycles and doing the same things they follow, they've had deflation across the board. And so their stock market hasn't grown in 37 years. And so that's where we're going. So I disagree with the inflationary aspect of the money printing side of the equation, even in the areas of inflation that he was referring to. And I'm glad that he clarified that, you know, difference between goods and services and asset prices. But the reality is I think that's more of a theory than it is based on what really happens, because we know deflation does happen. And we know inflation does happen in different environments, and there have to be different things that facilitate that. So I think in this case, though, we're facing deflationary pressure across the board, and that, a lot of that's because of demand, and money printing has nothing to do with it unless we get the economy back up and running. The economy's got to go back to the way it was. And so he's a little bit out of touch. to a certain degree.
And Jeff, what I want our income generation viewers to know, and I said I promised you right before the break, before the interview with Peter, that is, that we're going to get positive. We're going to give you some positive news. It's not going to be all negative and doom and gloom. But the reality is that if you're smart about it, the fact that there could be a 50 to 80% stock market drop and then a fairly quicker stock market recovery, maybe not so much of a quick economic recovery, but a quicker stock market recovery, means there's an opportunity for you. Because first of all, you remember the income generation, so you shouldn't be taking excessive risks anyway, because retirement's probably 10 years from now or even closer. Some of you are currently retired. So you shouldn't be taking excessive risks. So if the market right now is only down about 15%, there's no reason to ride it down from 15 to 50 just to ride it back up again. There's still an opportunity to take some of those previous winnings off the table, take your money off the table, take a deep breath, and then, there's no law that says that you can't get back in at some lower point to ride it back up again. In other words, you don't have to ride it all the way down just to ride it back up. That doesn't make any sense.
No, it doesn't, David. It doesn't make any sense at all because no one, it's impossible to be tactical with the markets. You either have to have a buy and hold mentality and hold on forever because nobody knows when to get in, nobody knows when to get out. Even the greatest market pundits on the street right now and on TV are saying, this makes no sense to us right now why the market is valued so high. What is the true value of the market? So, unfortunately, the game is rigged against the individual investor. If you're an individual investor at home, though, the stock market is not where you want to be to create income. That is an incorrect and failed strategy to create income. If you're living off dividends, there are much better strategies through fixed income that we've discussed many times on the show. Don't you? And I know you agree about that, Dave.
Yeah, and the reality of it is companies right now across the board are starting to cut dividends with the earnings reports coming out just as we speak, coming out pretty poor. Projections for next quarter, pretty poor. Yeah, they're going to be cutting dividends. So there are better ways to invest for income and to take some of the risk off the table. But also, Jeff, where you and I may disagree a little bit is I say, whereas you're right, it's hard to time the market, and I don't advocate that. The reality, though, is in extreme conditions like this, there are some occasional opportunities to take some of the winnings off the table, and then if we're right, if it drops to 50 or 80% down, then a great opportunity to get some back in. Certainly better than riding the market down from where it is today. So, Jeff, we need to take a commercial break. As you well know, we come back, we can talk about that a little bit more. You stay with us, too. We have more coming up right here on The Income Generation in just a moment. We'll be right back.
Investing for income? The idea has grown in popularity over the last several years due to today's volatile stock market. But if you're at or near retirement age, it's no longer just how much you've saved, it's about maximizing and protecting your life savings while minimizing your risk from market ups and downs. David J. Scranton's new book, The Retirement Income Story, is here to help baby boomers face the challenges of investing in this age of economic uncertainty. Visit theretirementincomestory.com to learn more.
You probably heard me explain before that one of the most important things for investors to understand is the difference between individual bonds and bond mutual funds. Well, like so many things, the coronavirus crisis has put a spotlight on why that distinction is so important. So understand that a financial advisor with a conventional Wall Street business model might tell you that bond mutual funds are the conservative options that he or she offers in a standard portfolio. In reality, though, that option isn't really much less risky than common stock. The really conservative option is a more actively managed portfolio of individual bonds. Why? Because with individual bonds, you're investing by contract. And you have two important guarantees that you don't get with bond mutual funds. First, an interest payment that's guaranteed at a fixed dollar amount for the life of the bond. And number two, the return of your principal if you hold the bond to maturity. And of course, that's assuming that there are no defaults. you have a certain level of control. Why? Because you have greater transparency, a fixed income, and a contract assuring that your initial investment will be returned to you at maturity. Therefore, any loss in value on your statement is truly only a temporary paper loss. The only real risk with individual bonds is the possibility of a company going bankrupt or defaulting. However, as we've also explained, in an actively managed bond portfolio, account managers are able to lower that risk through ongoing analysis and through strategic portfolio adjustments. On the flip side, with bond mutual funds, you have no contract. Instead, you're in a murky pool of holdings with no transparency and far less control, which is especially concerning in a recession or a time of economic crisis like now. Your advisor also doesn't have control because if your average investor panics and wants to sell out of the fund, the mutual fund manager is forced to sell those bonds at a loss. So even if you want to be a good soldier and hang in there and hold the bonds, it's not your call. And without you having the contract, your loss is a real loss. And that is the important distinction between bonds and bond funds. Basically, it's the same as the difference between investing strategically versus gambling. Because when you're in or nearing retirement, the stakes are high. Now let's bring in my good friend and co-host, Jeff Small. Now, Jeff, because you're such a good friend, I'm going to switch gears here. I know at the end of the last segment, I said that I wanted to get your feedback on this concept of occasionally timing the market. But because you're such a good friend, I could be honest with you and say, I really don't care what you think about occasional timing of the market. But what I do care about, because you're a good friend, is how are you doing personally? At home, the family, homeschooling. How's that going? Because it's for a lot of people, this what we're going through right now is psychologically damaging. It's stressful.
Well, for all of our viewers, including ourselves at home, Dave, we're learning to adjust. The old statement that your home is your castle has new meaning because it truly has become our castle. And so what we have found, I think, is that for a lot of us, including a lot of people that watch the show, is family has become the epic center of their lives. And relationships are getting closer. People are bonding more because we're forced to spend more time together. And we truly appreciate what we have, because what we had before is, without the social distancing was significantly different. So we're starting to value what's happening in relationships with people. And that's what I've discovered amongst a lot of other things. What have you seen, Dave?
Well, did you see my post? I know all of our viewers, every single one, follows my Facebook posts for the income generation. But I want to know if you happen to see my post from earlier this week, where I said that, we all feel like we're prisoners in our own homes. And in real life, prisoners take two paths. Some try to make, some go through their term and they get out and they're the same person that they went into prison as being. Others say, how can I improve myself while I'm here? And when they finally serve their terms and get out in public, they become a new and improved person. And, have you thought about, are there any things that you have that are personal goals or things that you've done, or maybe household projects that you want to improve upon? I hope that's what our viewers are doing. How about yourself? I know I've done some things.
Well, obviously the spring cleaning has happened. I've reinvented the green egg that I forgot about, that I'm cooking on now just about every night.
Aren't those great? Don't you love the green egg? That's a wonderful, wonderful tool.
I love the green egg. But also, Dave, I took a webinar on how to use video conferencing. And what I've discovered is that my children are getting their ballet classes, their music classes, their theater classes, their performing arts are all done online, including school. And consumers can learn sewing and artistry and even hair cutting. And so we all have to adapt. We all have to adapt to that right now.
Yeah, I've done the same things. I don't have young children at home like you do, but what I've done, for example, is it's unusual for a chartered financial analyst like myself not to know how to get into a Bloomberg terminal, how to use a Bloomberg terminal, how to access information. But we have a bunch of analysts doing that, bringing me the data. I've never had to do it, but I've always been curious about it. So I've decided this time, when I'm stuck at home, why can't I learn something? So I've gotten a feed for a Bloomberg terminal, and I'm now going to figure out how to get online and how to do it. Another thing I've never done is I've not been opposed to guns in any way, shape, or form. Being a conservative person, but I've never really even learned. So I actually went ahead and went out and bought a pistol, and we're going to go to the range and learn how to use it a little bit. So I feel like I'm learning some things I didn't know about before. So I guess I'm using it in a different way because I don't have the young kids at home. Don't go anywhere. We'll be right back with more to come from David Scranton and Jeff Small. Welcome back to the Income Generation. I'm David Scranton, and I'm here with my good friend and co-host, Jeff Small.
Dave, you got a gun. I don't think that Melbourne is far enough from Fort Lauderdale. I don't feel safe. You with a gun is kind of scary. Are you sure you're okay with a gun?
What are you trying to say? I am the most normalist person that I know. Obviously, you disagree, and I'd appreciate it from this point forward if you keep your opinions to yourself, Jeff. But you know, I've seen all kinds of different things. It's funny. I know somebody who never put puzzles together and now has worked herself up to a 3,000 piece puzzle, starting at 500 to 1,000, 2,000, 3,000. I know somebody who actually decided they wanted to learn to play chess and is playing chess on the computer and actually getting pretty good at it. So I thought that's kind of interesting. So there's a lot of neat stuff going on out there. People are taking this as an advantage to really, you know, bond with family, yes, but also maybe do some things they've always wanted to do, not just the projects around the house as you referred to a moment ago, although we all have those, but also, you know, some things, some goals and things that they've always wanted. So I think in some ways it's actually fun times in a way. Is it not?
I think it is, and what we've seen on our end with a lot of our customers is they're starting to discover technology. So they're being forced to utilize technology more and more, whether it's FaceTiming on an iPhone or FaceTiming through an Android. You know, you need to keep your social structures up, make sure that you see people. And so whenever I see a customer on Zoom video conferencing, I'm like, oh, it's nice to see a person because we're doing this distancing now. So you want to keep your connections up with folks. And you know, video conferencing is the safest and the best thing to do if you want to at least see the people that you're talking to. That's what we're experiencing, Dave, and I know you and I have been doing more than that than ever before.
You know, I feel the same way. I always thought, for example, that FaceTiming was just the most ridiculous thing. I know what the person looks like. I could talk to them over the telephone. Why do I have to see them? And now all of a sudden, you're right, we don't have that interaction anymore. So now when you get to see your friend or family member, it's like, oh, wow, this is kind of cool, you know? So before we run out of time, though, I want to make sure that our Income Generation viewers know what you and I both want them to know. From my standpoint, I want you to know at home that it's not too late to de-risk. The market was down almost 40% at the bottom just a few weeks ago. Now it's down only 15%. It's not too late to take some of those winnings off the table, because that last 15% really only erases perhaps the last year worth of gains. It's not too late. Jeff?
Well, I echo those same concerns, Dave, because the market is going up on three bases right now. One, the stimulus, which is the most in history. That's not going to bring demand back to consumers. And the second reason is because they've modeled a virus and the virus's decline, and assuming the market's going to come back and that the second half of next year, the economy will hit the high watermark again for market values. Those are all based on hope. This recent rally from the lows is a gift. Now is a perfect time. I could not agree with you more to de-risk.
Yeah, analysts say, buy the dips. Well, I say sell the peaks. Don't buy the dips, sell the peaks. We have more coming up on the Income Generation right here in just a minute. So stay here. We'll be right back. I'd like to take this opportunity to thank all of our guests for joining us today for another episode of The Income Generation, and I'd also like to thank you, our new and returning viewers. Now, understanding why your RMD allocation should be right for retirement income, understanding the difference between bonds and bond funds, understanding market history. These are just some of the fundamental things that I believe you need to know to avoid making common and costly mistakes. The current crisis has put a new spotlight on these issues because making any mistake now could be more costly than ever before. Here's the good news, that it's not too late to take action to help protect your investments. While the health crisis has hopefully peaked by this point, the worst impacts of the economic crisis may still be on the way. So as you continue to take the right steps to help protect your physical health, make sure you're doing the same when it comes to your financial health. Now is a perfect time to educate yourself about alternative investment strategies geared toward protection and income. You can find a wealth of information on the Retirement Income Store website, as well as links and contact information to help you learn much more. Of course, you can also find out how to get in touch with a financial advisor in your area who specializes in asset allocation, asset protection, and retirement income. Now is the perfect time to take action, not only from an economic standpoint, but also from a social standpoint as well. Each day as this crisis rages on, Americans and businesses are becoming more and more comfortable communicating and conducting business by phone and using online technology and all other types of technology that makes it possible. And this stuff is more user-friendly than it's ever been before. So stay safe, but please also take advantage of the current situation and take steps to ensure your retirement income is being addressed. Thanks for watching. If you're close to retirement, you really want to know how to maximize your money and protect it, it's absolutely essential that you stay informed and up to date. And right here is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week. Did you know that the Retirement Income Store publishes its own newsletter? Each month, we share helpful information, research reports, and other resources to help you navigate the complexities of planning and saving for retirement. And for a limited time, we're offering a 3-month trial subscription to the Retirement Income Store newsletter. Visit theretirementincomestore.com to learn more.